Bitcoin is down more than 14% this year. Ethereum, down over 30%. Portfolios are bleeding red, social media is packed with traders declaring crypto dead for the 100th time, and the altcoin season index is stuck at just 37 out of 100, nowhere near the 75-point threshold needed to call it a real alt season. On the surface, it looks like nothing is happening, but look a little closer. Hyperliquid is up more than 130% year-to-date, Zcash has surged nearly 50% in the last 30 days alone, and Bitcoin exchange reserves have fallen to their lowest level in 7 years. So what's really going on? Because while most investors are staring at a boring market, smart money appears to be positioning for something very different. Today we're breaking down why the old 2021 crypto playbook is officially dead, the two major trends sophisticated investors are watching right now, and the framework that's replacing the buy everything and pray strategy that once made fortunes. Let's dive in. If you're still trading crypto like it's 2021, you could spend the next year and a half wondering why nothing works anymore. Back in 2021, almost every coin went up. You could practically throw darts at a list of random tokens, buy whatever you hit, and watch your portfolio soar as waves of retail money flooded the market. It wasn't skill, it was liquidity, and that environment is gone. More importantly, it's probably not coming back. The crypto market of 2026 operates under an entirely different structure, one shaped by three powerful forces that barely existed during the last major bull run. Factor number 1, ETF concentration spot. Bitcoin ETFs have completely changed the flow of capital. Combined inflows now sit at roughly $58 billion, with total assets under management approaching the $100 billion mark. Collectively, these ETFs now control around 7% of Bitcoin's total supply. Think about that for a moment. Every dollar flowing into a Bitcoin ETF is a dollar that isn't flowing into thousands of speculative altcoins. Money that once spread across the market is now concentrating into a handful of institutional products. Factor number 2, the VC Unlock Avalanche venture capital-backed token projects are creating massive supply pressure. In 2025 alone, nearly $97 billion worth of previously locked tokens entered circulation through vesting schedules. Weekly unlock events frequently dump between $650 million and $770 million worth of new supply onto the market. That's a lot of sellers. And every time those unlocks hit, prices face another uphill battle. Factor number 3, token oversaturation. Simply put, there are too many coins. More than 11.6 million crypto tokens failed outright in 2025. Meanwhile, activity on Pump.Fun collapsed dramatically, with active wallets falling from over 5 million to under 2 million within months. The meme coin casino that fueled so much speculation during previous cycles is showing signs of exhaustion. The result? Bitcoin dominance continues climbing. It currently sits around 59%. Compare that to the peak of the 2021 altcoin frenzy, when Bitcoin dominance dropped near 40%. That nearly 20-point difference explains why broad altcoin rallies have become so rare. In fact, 18 of the 20 assets in the CoinDesk 20 index are currently posting losses. The ETH to Bitcoin ratio has fallen nearly 20% this year, and Ethereum itself, historically the leader of altcoin rotations, is down more than 30%. The old rising tide model simply isn't working anymore. Because the tide isn't lifting every boat, it's lifting a select few. The new filter, revenue matters. In 2021, narratives drove prices. In 2026, cash flow is becoming king. The market is increasingly rewarding projects that generate real revenue rather than simply promising future adoption, and no project demonstrates that shift better than Hyperliquid. Recently, Hyperliquid's Hype token reached a new all-time high above $64, pushing its market value beyond $13 billion. But the real story isn't the token price, it's the business underneath it. In just 1 week during May 2026, Hyperliquid generated approximately $11 million in protocol fees. That represented around 43% of all blockchain fee revenue produced across the entire crypto market during that period. Let that sink in. One protocol generated nearly half of all blockchain fee revenue. For the full year 2025, Hyperliquid processed roughly $2.6 trillion in trading volume. That's actually more trading volume than Coinbase recorded during the same time frame. Its open interest has grown to approximately 92% of Coinbase's perpetual futures business. And here's where things get really interesting. Approximately 97 cents of every dollar earned in fees is automatically used to buy hype tokens directly from the open market. Not through promises, not through marketing announcements, through code. 1. The mechanism known as the Assistance Fund operates automatically at the protocol level. No committee vote, no executive decision, no multi-sig wallet approval. As trading volume grows, buybacks grow. It's entirely mechanical. And so far, that system has directed more than $1.2 billion into open market hype purchases. That's why some analysts believe the market still isn't fully pricing in what Hyperliquid has become. According to Bitwise Chief Investment Officer Matt Hoogan, investors may be valuing Hype as just another crypto trading platform when it may actually be competing with traditional financial giants like CME Group and Robinhood. And if that assessment proves correct, the market could still be underestimating its long-term value. But Hyperliquid is only one example, because the broader lesson here is that crypto investors are no longer rewarding hype alone, they're rewarding businesses. And that shift may define the next phase of this market. If you find this video helpful, don't forget to subscribe and drop a like. Leave a comment. We will be back with more financial information very soon.